Joining us now is UBS Alignment Partners Managing Director Alli McCartney. Welcome back, Alli.
Hello,
good to see you. Hello.
You too. You too. Yes.
I don't know if you were just listening.
Go ahead.
So I was going to ask you about what Dick was saying and whether you were listening and whether there's, this on top of the Moody's downgrades of 10 regionals recently, whether this represents maybe an underappreciated risk to those that are out there saying soft landing, no landing, everything's looking okay.
There are a lot of underappreciated risks, right? And I think Fitch is coming in, and I was interested in the point about, at the end of the day, why they're doing it. But I think what it highlights actually is the risk in Washington and sort of the partisan risks that are definitely out there as the pendulum swings. And so at the end of the day, what we've seen in the last 2 weeks with Fitch's movement, Yellen coming in and speaking, and then largely just sort of a surprise yield move last week in bonds is like a re-rating and a de-rating in government debt. We think it is going to be relatively short-lived. If you look back to history, to the sort of what the U.S. sovereign bonds represent in terms of liquidity and safe havens. I mean, you look what happened with Argentina yesterday. So we don't think this is going to be long-lived. So we view it as a great entry point. But I think, look, the whole problem with this is it's a cycle. When you use the word cyclical, right, that's it right there. At some point, there will be a recession. But in this one, I mean, the consumer is absolutely amazing. And we just keep on going. We just keep on spending. We spend from goods to services. But at some point, a 7% mortgage rate and a 26% handle plus on credit card debt is going to pull back. And then we need to see what's really going on under the hood, minus a really healthy, stimulative consumer.
But for now, you're content playing the cyclical trade on the idea that we're not seeing recessionary concerns?
So here's cyclicals, value stocks, small cap, wherever you go right now that is largely not big tech, those sort of magnificent seven, has been really underappreciated. And there are a lot of reasons that could be. But when you have times where there is really, you can drive a truck through the underappreciation from absolute measures or relative to history for certain assets versus another, for example, the Russell value versus the Russell growth, you have to believe, and a lot of investing, quite frankly, is believed on, is moderation and coming back to that. So when you see what's happening or what hasn't happened yet with energy, with industrials, consumer staples continue to go, with the U.S. consumer being the little engine that could, we think whether it's simply that there is the catch-up trade, right, that those seven stocks stay where they are or come down a little, as we've seen, but that the bottom, the laggards come up, or whether we do have tough times ahead, that is the place that we want to be.
Alli, as far as positioning goes, what do you think happens once we get through August, through Jackson Hole, everybody's back to work? Do you see a lot of institutions going to have to put long positions back on? And does that mean that we start talking about chasing going into Q4?
I think we're already chasing, though, Carl. Like, if you've been talking about having looked at all the disclosures coming out of all the big hedge funds and asset managers. Shorts haven't worked. They haven't worked at this point for 8 months. And so even a couple of weeks ago, our hedge fund desk was telling us that there was, overinvestment to the ranks that they hadn't seen in a very long time. So the question is, can equities keep on going if people are legitimately rotating into bonds? And if there is a view that we have seen peak rates in cash, and so you need to get in the market to make long-term, to really make long-term money, because 5.4% sounds really great until you realize that the opportunity cost of that 5.4%, whether it's in 3-year bonds or whether it's in dividend-paying equities, is significant and is going to be a drag to your portfolio.